I think the biggest one is just that it's easy, that it's ever going to be easy for anyone. There's never an easy stance to take because whatever you do, there's some sort of risk. And investing is not, there's no like correlation there for most people.
Welcome back to The Long-Term Investor. Today, I'm thrilled to be joined by Ben Carlson, author of the new book, Risk and Reward, but you probably know him from his blog and other book titled A Wealth of Common Sense. He is also the co-host of the wildly popular Animal Spirits podcast. Ben, thanks so much for joining today.
Glad to be here, Peter.
During my workout today, I was thinking there may not be somebody with more published words on this topic than you. And on one hand, like if people regularly follow you, there really isn't anything I could ask where I could generate an answer that would catch them off guard. But for those who are not familiar with your work, they're going to love this conversation. I think they're really going to like the new book. Let me just start right at the beginning. You kind of open up saying, hey, there's no secret to investing. You also are saying right out the gate, I'm a long-term investor, but people push back against me. So as you started to write the book, as you started to compile the information, like what were some of the things that you were trying to poke holes in most with what you were doing here?
I think the biggest one is just that it's easy, that it's ever going to be easy for anyone. There's this idea that like whatever you do with your money, whether you're buried in the backyard or you put it all in T-bills, you put it in the most wildly speculative things you can, there's always a risk with whatever you do. So it's kind of like there's never an easy stance to take because whatever you do, there's some sort of risk. And so I just wanted to outline all the risks because I do get a lot of pushback in terms of, well, what about this and what about that? People love to do the what about game, right? Which, I think is fair because there's exceptions to every rule that there is. And so there's no like investment philosophy or investment strategy that is foolproof, that works all the time. And that's kind of what I wanted to show people is just that like whatever you do with your money, you're going to have to make some sort of trade-offs and it's never going to be easy. Like you can have the simplest strategy in the world. You can put it all in one index fund or one target date fund or one stock or whatever it is, but there's still going to be risks involved in that and it's never going to work all the time. So it's like, how do you handle those times when whatever you're doing doesn't work well?
So if you're an advisor, you're trying to showcase value through some of the investing. And so maybe there's like a little bit of a smoke show, a light show involved where it isn't really necessary. Do-it-yourself investors, I think, are always looking for a deal, whether that's something cheaper or like a trick or a loophole. I won't like totally give away everything that's in the book so people actually go and listen, but you give an example that I think I've seen you write about before, like with a study on goalkeepers, like in penalty kicks. And generally speaking, when you're a goalie, you have to just guess like, is it going left or is it going right or is it coming right at me? And the data shows that, hey, it's better just to stand there and do nothing. But as a goalie, you feel like a moron if someone just launches balls left and right. There was a couple narratives in that chapter I really like, but the main point being like making it look easy requires plenty of work. And more often than not, like more effort doesn't equate to better results. What are some ways in which you see that transpiring with people who read your blog or listen to your podcast or clients you work with?
Yeah, I think there is always this illusion of control because with other areas of life, if you work harder, you should improve and get better, right? If you're playing a musical instrument and you practice it all the time, you should be better at that musical instrument. If you're working out all the time, you can see some changes happen in your body. If you study more in school, hopefully your grades improve. And investing is not, there's no like correlation there for most people. And I think the hard part these days is because there's just so many smart people that are involved in the markets. In the past, I don't know, in the 50s and 60s, there's these little stories of Warren Buffett like knocking on the door at Geico on the weekend to talk to the CEO, right? And you have to send away for the reports. Now the information is everywhere. There's literal rocket scientists and code breakers that are trying to beat the market, and so I just think that part of it is just like I'm going to try harder. I'm going to be the smartest person. Like it's almost impossible to outsmart people out there because there's always going to be people smarter than you. So I think there is this like illusion of control, this bias towards action where it's like if I'm doing something and I put my hands on the steering wheel, it's going to make me feel better. Like a release valve, like, oh, at least I did something, right? I bought something or I sold something or I made this change or I changed the allocation. I think just sitting on your hands is extremely difficult. And it's kind of interesting because I think that there's never been a better time to be an individual investor. The barriers to entry have been just like bulldozed, right? There's no more trading fees. You can trade on your phone if you want. It's never been easier to jump in and out. Like there's strategies that you can put in that for pennies on the dollar, fractions of a penny, where if you would have tried to put this strategy together 20 years ago, it would have been so cost prohibitive. It would have been impossible, right? These baskets of ETFs and stuff. When I was first coming up, it would have been impossible. So all those barriers to entry being down are great for individual investors. But the lack of barriers makes it way more tempting to do something, right? To dive left or dive right. I think that's the hard part, is there's never been more products or strategies or vehicles or the ability to make a change when you want. And if we get like 24/7 trading with most of the stock market, which it seems like that's where we're going, it's just going to be more temptation. I think that's the hard part for people, that the ability to do nothing as a decision is way harder than it was in the past.
You know, and one of the things that's hard for me, at least, I'd be curious on what you think about when you publish something, is sometimes like the absolute simplest thing is not the best thing for an individual. Like I myself have a ridiculously simple portfolio because it's really what works for me. But even though the philosophy is the same as what we do for our clients, our clients have a few more moving parts. Not everybody should just own the S&P 500, like Warren Buffett once said, annoyingly, in my opinion. When you think about maybe where people are there places where people can get too crazy in oversimplification or over fee adverseness? Is adverseness a word? I don't know, but you know what I mean.
Yeah. I think there is, some room for complexity. Like if you do have all your money in one fund, right? It's one fund that has all these different allocations with it. It's all under one umbrella. It's easy because it's tax efficient, but maybe it takes away some optionality. Like you don't want to sell out of a little bit of everything when things are going down. You want some money, right? You want to have a liquidity source that's moving in a different direction, and so you want to be able to rebalance your portfolio in specific ways. And I think if you just have one fund that holds everything, it's much harder to do that. So yeah, I think that having more steps of complexity, it's not always bad. If you think about, this is kind of stuff that's just really big in the wealth management space in the last couple of years. It's funny how we've moved from portfolio alpha was the big thing. Now it's like tax alpha. And a lot of these new tax strategies, if you dig into them, are very complex. And we've put them in front of our clients. And a lot of times we preface it with, listen, just so you know, this strategy still fits with our philosophy, but it's way more complex than anything you're probably used to dealing with. And you have to think about like the complexity in it, and like the stuff that can be done these days that couldn't be done in the past. Again, on that side of things, is kind of mind-boggling. But you have to make a choice. Like, is that complexity worth it? For some people, it really is, because they hate taxes more than they like making money or something. It kind of comes down to trade-offs. So I do think that there are people that have the ability to introduce more complexity. I think you just have to have some sort of like goalpost along the way to make sure transistors or whatever, to make sure you're not going too far with it.
Yeah, I mean, there's got to be good complexity versus bad complexity. Future blog post. You write every day, so you run with that one. I don't have time to write with every idea I have, but when I think of good complexity versus bad complexity, when you're doing it on your own, I think complexity is a real problem. When you have an objective third party, like, yes, you and I both work for investment advisors, so like there's bias in what I'm saying, but like anytime I add complexity to my life outside of my finances, if I can have someone who's objective and understands the trade-offs, that can be helpful. In general, I just feel though that like most investors who watch this stuff closely, or who are following like your work or following my work, there are pieces of the markets they misunderstand. But I also think they sometimes misunderstand themselves. Like, do you feel like there's a bigger one way or the other, misunderstanding markets versus misunderstanding themselves?
Yeah. And I think the hard part is that I think some people in the wealth management field take it for granted. Like you and I pay attention to this stuff all the time. We're in this every day. We're reading about it. We're following it. I think there is always the risk of someone who's just dabbling in it, getting in over their head. It's like a little knowledge can be a little hurtful, I guess. I think that is where some people, get tripped up. And so I think that can be a problem. But you're right. It's like, I'm just going to dip my toe in the water into this and see what happens. If you don't understand how these things work, I think that's the hardest part about introducing complexity, is just that when it's time to rebalance into the pain because it's not working, I think a simpler approach is easier to rebalance into. And if you, because my previous life in the nonprofit space was all these hedge funds and private equity and venture capital. And it was always really difficult in like these board meetings for these investment committees to think through, they'd have this one's green, this one's red, this one's yellow. Should we get rid of this and punt it? And usually the reason to punt on a strategy was the performance stinks. But if you really trust a strategy, it should be the opposite. You should be leaning into the pain and rebalancing more into that. But with a complex strategy, it was always like, we don't know if this is coming back. And I think it's easier to rebalance into the pain with something that's simpler, right? It's not like this discretionary asset manager who's going through a hard time. I like to say that like no index fund has ever shut down the fund because it's going through a divorce and needs to spend more time with its family. But that happens to like hedge fund people all the time, right? So I think that's where it can be tricky. And to your point, like outsourcing, yeah, sometimes you need someone to help explain to you the potential pitfalls of these things, who really understands what's under the hood and not just like the shiny sales pitch.
Yeah, and I think that as I listen to you speak, I think about, well, maybe it's like simplicity is just that you, the end investor, as well as the advisor themselves, can actually explain it. So like you wrote something in one of your books forever ago. You have a number of books about like, hey, like investment philosophy is sort of like what it all rests on when it looks all broken. And if you can't explain what you own and why you own it and what it might do throughout different scenarios, then yeah, you're more likely to chase performance and bail. I mean, I think the other thing is that for people who are real students of the market, they are somehow able to separate long-term investing versus something else that is not such. Maybe it's not quite trading. I don't know what that like place between trading and long-term investing is. Maybe there isn't a middle ground, but basically like the long-term is an eternity to live through in the moment. And the big theme that you talk about throughout the book is loss aversion, and just generally speaking to say like, you have amazing data tables throughout. Like, look, if you're watching us on YouTube or Cheddar, or listening to us on the podcast, like Ben's book has so much data in it. Like that alone, if you don't read a word of his writing and you just look at all the data tables, you're going to get a ton out of this stuff. And when you look at like past 20% drops, you can say like, sure, I can handle that. But in the moment, it just seems so much scarier.
Right. Yeah, sure. I can look back and know that bear market came back, but how long is this going to go? Is it going to go from 20% to 30 or 40 or 50? And that's the hard thing. And the loss aversion point, I think a lot of advisors, like one of the things they hand you on day one, like the advisor 101, is just tell your clients just ignore the noise, right? Just ignore the noise. Don't pay attention to it. It's easy. I think that is just not effective advice anymore, because like it's impossible to ignore what's going on unless you live in a cave. And even then you might have like cell phone reception and still be able to pay attention in the cave you live in. So I think you just need a way better filter in place, whether that's information or opinions or stuff to pay attention to. Like you said, it could be outsourcing to an advisor. We have plenty of clients who say, like, listen, I've done this my whole life. I'm a DIY person. I'm ready to I don't want the brain damage anymore. I want someone else to help me. And I think it's also can be for stuff you will or won't invest in. I think advisors get into trouble with this stuff too, right? So Josh, who I work with, always talks about a good advisor is like a bouncer at a club who holds the line, right? Keeping and when it comes to your portfolio, it's like keeping stuff out. I think we've learned, this in this cycle, especially with something like the private credit interval funds that's going on right now, that a lot of advisors maybe didn't understand like their clients' tolerance for risk enough with this stuff. And I think they even got into, even the private managers have been saying, like, maybe this stuff wasn't explained good enough, because I think they're even shocked at how many people are trying to get out of this stuff. So I think they don't have to be like ironclad rules, but I think having some sort of like limitations in place is helpful too. Listen, this whole subset of products or services or whatever, like that can be helpful for certain people, but for 95% of our clients, we just won't touch it, right? I think having those kind of filters in place, I think that's how you deal with this stuff, is just having a lot of filters and limitations and make it so there's higher hurdles to get into some of this stuff. I think that can be helpful.
Yeah, the filtering information is key. I don't know how often we can tell people and have them really listen. I mean, there's just absolute garbage all around us. And how do you find what is a good resource versus a bad one? And for those listening or watching to us, who says we're a good resource? I mean, naturally we think we are, but I just, I've come to a point where I realize, and I try to educate clients, try to educate listeners and followers, like losses are normal, market's going to go down, different things are going to win, don't chase them. And I think people are no longer worried about the actual data loss itself or the volatility. It's the story attached to it gets them so nervous. And generally speaking, I will talk to someone who says like, hey, I'm not a market timer, but like ... And then they want to do something or like, I know we can't time. You actually have a series of them. I wrote them down from the book. Like when people start getting nervous, they'll say like, let's just sell everything and wait for the dust to settle, or I'll go to cash and then buy after the market dips, or, like, what if I put money to work in stocks and then the market crashes even more? These are things that people go through. We've been doing this long enough. You just can't tell when there's going to be a top or a bottom.
Yeah, because you have to be right twice. And I know people who sold in like the fall of 2008 before things got even worse, right? And at the time they looked and felt like geniuses. And then so many of them, we had so many clients come to us in like 2013, 2014, 2015, being like, I sold. I got out relatively early. The market fell 10%. Things seemed like they were going to wobble. I got out. And I never got back in. And the market has left me behind because I was waiting for a 30% crash that didn't happen or whatever. My own father sold all of his stocks, the Friday before Lehman Brothers failed. He sold them all. He got kind of a tip from someone at work. He did it. And I said, all right, fine. You missed maybe one of the worst 6 months period we'll ever have as far as the economic system goes. But please start slowly but surely legging back in. And it took him a couple of years to get back in. And even then I'm like, sure, you slept at night, but then on the way back up, then you were anxious the whole time. And that's the hard part is like, if you're going to ever try anything like that, you need like specific set in stone rules in place that you're going to follow, right? Some sort of trend following or whatever. And even that is really hard to do because a lot of time you're going against the grain. And so I think that if you're just trying to guess here, like how far this will go, and I'll get back in when things feel better and the headlines change. And I give a lot of examples in the book that like it's never, the market doesn't wait for you, right? The market bottoms way before earnings, way before the unemployment rate, way before the economy, all this stuff. The market doesn't wait around. But sometimes the market bounces, then it falls again. And so it just plays so many head games with you. And that's kind of the point I wanted to bring across, is that trying to figure this stuff out in real time is so hard. And I think it's just way easier to have an allocation that like takes this into account, right? That there's going to be these periods, there's going to be the volatility. Like just find an allocation that you can stick with and live with. That's the whole thing.
You bring up an example you've used in the past, Bob the world's worst market timer, where he like keeps putting in money at market highs. And you could take a couple different angles of it. But one of the things that strikes me as you were talking about your dad getting back in the market and just like living through the financial crisis and the period after it, was that I don't feel like the all clear bell was rang until like the late teens. People were worried about European debt. They were worried about double dip recession. They were worried about US debt, all these different things. And I don't know how this feels for you, but every time we've had a bear market since then, I'm kind of like, meh, this isn't that interesting. Like the financial crisis, I was lucky enough to be working in, and that was my first real bear market. And everything since 2022 is really slow and painful. But even then I was kind of like, for a bad market, this just isn't that eventful or exciting or scary.
I agree. I kind of came up at the same time as you, and it was my first real, I took a new job in July of 2007. So I worked for a few years. And I came to this new firm, and it was right when the credit market started really like getting disrupted, and you had this like quant meltdown and all this stuff happening. And I think it was a real eye opener for me about like, what real risk is like and how freaked out people can be. And that's one of the reasons that I started writing, because coming out of that, the pessimism was overwhelming. And it's kind of funny because the 2020 seems to be different. Like it's the other side of the coin. There seems to be more optimism among market people. But I saw all these nonprofit institutions managing, hundreds of millions or billions of dollars, trying to get all their money into hedge funds and black swan funds, like after the crash had already happened. And it's like, no, you don't realize the stock market just fell almost 60%. Like I wasn't out here pounding the table for a bull market, but I'm like, if this has happened in the past, this is like, better things come from this. The prices are way lower. The valuations are lower. The dividend yields are higher. I'm reading this stuff in books because it was my first time experiencing it, but I'm like, this is the stuff they tell us about, right? These are these once in a generation system resets. And yeah, you're right. It never felt clear after that. I do remember the double dip recession stuff was huge. 2011, we almost had another bear market, and people rarely felt, like, is this okay now? And no one would have possibly predicted like a 16-year bull market from those levels, right? No, impossible. Like, we're not going to have another real recession for that long. It's kind of hard to believe that it worked out like it did.
We went years without even a 10% drop. And I remember, at PlanCorp, I was working, and there were a number of employees who had been at the firm for years and never seen the market go down 10%. And they were really nervous. And I was like, wait, what? Like, guys, just like wake me up when we're down 30%, and then we can send the panic email. But in general, I think being a student of history helps. The fact that we pay such close attention helps. The fact that again, you're publishing every day. I publish probably every week, but documenting your thoughts really helps give you a clear vision of what it was you believed at the time about the future, about the past. And I think one of the traps that investors fall into is that they have a belief and they forget when they were wrong. And if they were right, they forget how they were right, or maybe like price action matched what they expected, but for totally different reasons. Let me pivot a little, because one thing where I feel like people's narratives have shifted a lot and where emotions come into play is inflation. Like, we talk about coming out of the financial crisis, there was no inflation for well over a decade, arguably 2 decades. And here we have inflation at 3%. And I realize like inflation hits everybody differently, and there's different pockets where it's higher. But realistically, like, we just weren't used to rising prices. We are currently experiencing historically average inflation, and people are losing their minds. Inflation is a big talking point in the book. I guess, roundabout way, let me ask you, what do you think is most important for investors to know about inflation right now?
I mean, I think for the long term, it's like your number 1, 2, and 3 risk that you're fighting against. But I think in the short term, we've learned this decade, I think I even underestimated the psychological toll that it can take. And part of it is because we hadn't had that. It's kind of like people who've never experienced a real financial crisis or bear market. I don't think you realize how people will react. Because, we had that one time rising tide, and then the rate kind of comes back. It's like, well, we're back at averages. But though that price increase happened, and that some of the examples I gave in the book, I think, is just that when people see their wages and inflation are pretty highly correlated, right? Everyone wants to go back to what the prices were in 2019. No one wants to go back to the wages were. And I think people don't realize that trade-off, because they think, well, the wages, that was me, and the inflation, that was someone else, the government or whoever you want to blame. And so I think that psychology behind it is really fascinating, and how people change their outlook, right? I gave the example in the book of the studies that show when egg prices rise, people drastically cut back their consumption of them. But when prices fall, it doesn't really change as much. And so that it's almost like inflation is the loss aversion piece, right? It's almost the same psychological piece of it. And I think that's the hard part to grapple with. And, it's hard because I always find it interesting that there's certain items that we adjust for inflation and other ones that we don't, right? Everyone adjusts GDP for inflation, right? Because inflation is a part of it. But we don't adjust like oil prices or gas prices. Some people use real returns for stock, but very few people actually do, I think. And I think part of it is because there's, like, as you mentioned, there's no one true inflation rate for everyone. Everyone has their own personal. So I think you just have to understand that your money is going to be less in the future because of inflation. As long as the economic pie keeps growing, prices are going to be higher in the future than they are today. And that's like the number one reason to invest your capital instead of just sitting on it.
Well, and I'll spoil some of the book. You go through 3 of the best inflation hedges, one of which being owning a home with a fixed rate mortgage. And you go so far as, and I agree, calling the 30-year fixed rate mortgage one of the greatest consumer financial products ever. Like, in terms of Mount Rushmore, you got index funds, you got 30-year mortgages. I don't know who else is up there, but a lot of times people want to, again, trade their portfolio around inflation. Historically, stocks have outpaced inflation by about 7% per year over long periods of time. But that's like, we have like 200 years worth of data of that from Jeremy Siegel and Schwartz. Bonds, depending on how much term risk you take, can outpace it by a percentage point. I think when we're investing, like, kind of that first principle level thing that I always go back to is, hey, like, why do we invest? Well, we got to grow our savings greater than the rate of inflation without taking undue risk. Now, what is undue risk? You could write a whole book. There's a whole bunch of undue risk that people take. In general, I think where people miss things the most is that they just see like some degree of predictability, some degree of ability to control outcomes or control their destiny through the way in which they invest. One of the topics you cover that is one of my favorite and doesn't always find its way into books like these are complex systems. Before I just go on a rant, because this is a big topic for me, anything in particular you want to share about that topic? And I'll try to make you the star of the conversation and not just go off on my own tangent.
No, I'd love to hear your thoughts too, because the markets today are so much more complex than they were in the past. They're just, if you read old books about like the 50s and 60s and 70s, there wasn't a lot of trading going on. Like the volume was much lower. The world wasn't quite as financialized as it is today. And I think the markets just matter more to everyone now than they did in the past. I walked through the history of how many people even owned stocks in the past, and it's so much higher now than it was. The 401k and the IRA and all these things that happened that got more people invested in stocks, it's a great thing, but it's just everything is so much more interconnected now. And I think we've realized that, okay, these markets are really important. We can't let like another Great Depression happen, right? If COVID would have happened 50 years ago, who knows how bad things would have gotten, right? I don't think we would have had the same response. I don't think things would have gone as well because people couldn't have worked from home, and it would have been an even bigger disaster, I think, than it was. So I do think the fact that markets are more interconnected than ever, and every time something happens, we try to just fix them. I think we're just like opening ourselves up to new risks, and I don't know what that means. Do we have like more flash crashes in the future or something? But I just think it's more important in everything now. Markets are than they were in the past.
So Michael Mauboussin introduced an idea to me, at least. I mean, he introduced it to the world, but where he has a couple books, some of which are like More Than You Know is just like a series of essays, but he's written on complex adaptive systems for a long time. And there's this study he references from a physicist where, like, if you have like one of those sand timers, why can't I think of what they're called? But, a little timer you flip over and the sand pile grows within it.
Yeah, we always have one of those for the board games I play with my kids.
Okay. Yeah. And so like as the sand keeps hitting it, like you get these little cascades off the hill. And there's a physicist who tried to like recreate the conditions in which an avalanche of sand occurs. And so like one drop of grain of sand every single time onto the same spot. And what he realized is that like every single time you couldn't predict when an avalanche would occur, how big it would be, because each sand, the interconnectedness, they all interacted differently with each other. And like this idea that the markets are so interconnected that the whole is greater than the sum of its parts, probably like the most important idea, where if you have your finger on the pulse of the market and you know every single thing that's going on, you still don't necessarily understand what's going on because it can all be random. And I think for me, the biggest thing that people don't think that much about when I am speaking to people who are worried about the future, concerned about what just happened, is like, hey, there's infinite futures. If we rerun this scenario 10,000 times, like, does this happen again? And the answer is probably no. But
yeah, there's no counterfactuals, right? You can't.
Right.
Like, I think if we would have done COVID again 100 times, like, I think we're in like what
you
happened.
came out in a good way this time.
Yeah, I think it was like the top 5% of outcomes. It could have gone way, way worse than it did, I think. And it is funny because people have the hindsight bias after something happens. Well, of course, like after Liberation Day last year, we had this really fast bear market. And then we back off the tariffs and everyone goes, oh, so I knew that was going to happen. But like that was no one knew for sure. That's easy to say after the fact. While you're in it, it's much harder to think these things through.
That's going to ruin the blog post that probably you and I write once every 4 years. We're like, hey, politics and like your portfolio don't matter. Like who gets elected and the policies they're talking about. Really throws a stick into the gears of that one. But
people try to throw that one on my face. Again, the exceptions to the rule, people love to point them out. But it is kind of funny just considering everything we've been through this decade. And the stock market is up like basically the same annualized rate as it was in the 2010s. Completely different environment, right? The inflation is different and a pandemic and all this crazy stuff, the Liberation Day and war and all this stuff. And the stock market is still up the same amount as it was in the 2010s. It's kind of hard to believe.
It really is. I think it's one of those things where like long-term investing in many ways can be like synonymous with being an optimist, at least when it comes to markets. My default setting is not one of being an optimist. But when it comes to investing, it most certainly is. And I think a lot of it has to do with my familiarity with market history and like just a general understanding of how markets work. Sometimes being an optimist kind of looks dumb. Being an optimist doesn't mean having your head in the sand and ignoring all the things around you. I think it's just, kind of looking at the base rates of some of this stuff and kind of looking out to the future and saying like, okay, given this information, what is most likely to happen? Because the future is inherently unknowable. Like, to me, probability is the only way to move forward. And you have a chapter in the book titled The Perfect Portfolio. Now, my book coming out in September is called The Perfect Portfolio. Cullen Roche and I had some issues with titling where like he was going to use that title and then I was going to use yourperfectportfolio.com. I even have the URL. And then he started using that. I was like, oh, geez. So either way, one thing that you say in the chapter that I also say in my book called The Perfect Portfolio is that there is not a singular perfect portfolio for everybody. It's basically a mirage. You really only know after the fact. So like, if the perfect portfolio only exists in hindsight to you, I mean, what does a durable, good enough portfolio look like for a real person?
It's funny because I've talked to a number of ridiculously smart quants over the years who create the most optimized, backtest looking portfolio strategy they could possibly do. And then they're like, I'm just going to put this out in the world and money will flow in. And they don't realize that the most optimized version of something can be like the worst one for behavior, right? Because they don't account for emotions and volatility. And they're kind of like scratching their head, like, why isn't more money coming into this? Did you not see what I did here? This thing is perfect. It's like a godlike back test. And they don't account for real world scenarios. And I've heard from a few people, like Corey Hofstein, who, is one of the persons who said, people who said, listen, I had to change my quant brain to understand behavior too, and figure out something that someone can actually stick with versus like the most optimized version of this strategy or portfolio. And I think that's the hard part for a lot of people who are especially like spreadsheet based is what's the most optimized version. And there are certain people, you and I have met them, like the DIY to the fullest people who they want the most optimized version of everything. And there are certain people like if they don't have that, they're not happy, right? The lowest cost, the lowest friction, the highest tax efficient, whatever it is, they need that. But there's other people who they need some sort of a release valve. And I think that's probably one of the areas that I've changed my mind about the most over the years is I was kind of one of those more optimized people before. But then dealing with actual human beings and wealth management clients, you realize like some people just need to pull a release valve every once in a while. They need 5 or 10% of their portfolio where they can just trade stocks and go crazy and be nuts. And then they can time the market there. So I think you have to understand the personality of the person and like, is this, exception over here, this small thing we're doing, is it going to allow the rest of the plan to just keep working and like not get in the way? And they have this one release valve like, oh, just let me do this and I'm happy. I think that's the really hard part about like finding perfection. I just think like the thing that you can stick with, I've learned is just there's not like one way for everyone to invest that I've come to. I don't think it exists. Even if you have really strong opinions about like the way people should invest, I think a lot of it is so personality based. Like I'm sure you've had financial prospects come to you and you realize like there's not a fit here. Like what I'm doing is not going to work for you, or what you want is not what I can give you. And like that's okay. I think you just have to define it ahead of time and not beat your head against the wall trying to make the square peg fit in the round hole.
I'm with you 100%. And you're kind of touching on some of your big beliefs that you have in the epilogue. You have 20 things I believe about investing. I'm curious, like, of those, are there any that have grown stronger over time as you continue to write and advise others?
I do think as much as I like following it, and obviously like simple over complex is one of my big sticking points. That's a big piece of my philosophy. But I do think that there are people who are 10 times smarter than me about the economy. And like you can slice and dice the economic data in so many ways these days. And it's funny, I think that it always makes one group of people miserable because like, oh, this objectively piece of data in the economy is good, but it hurts this people in this group. And I think our ability to slice and dice it is just shown how complex it is. Like this $30+ trillion economy that's kind of like turning a battleship in a lot of ways is just, it's really almost impossible to forecast, even by the smartest people. I don't think, we basically shut the economy off and shut it back on for a month in COVID. Other than that, we haven't had a real like cycle, like an economic cycle. We've had parts of the economy that are hurting and parts of the economy that have been in like recessions in the last, 16, 17 years. But I think the people who think that they can forecast the economy and what it means for the markets, I think it's almost impossible. And I love paying attention to this stuff, like what's going on. I think it's fascinating, but I don't think that me paying attention to it has helped me become a better investor in any way possible.
Well, maybe it has because it makes you more humble. I mean, that's the only thing I can think of is like there's some mix of like psychology and quantum physics that would allow you to really have your finger on the pulse of the market. But I think in general, it is so much fun to watch, at least for me, and probably for those watching or listening to us. Like if you're this far in the conversation, chances are you're super into this stuff. And so like, yeah, it's hard not to look away and get fired up about it, or, you know, have emotions seep into the process somewhere one way or another.
Like if you would have taken the headlines from COVID ahead of time, people are going to stay in their homes. It's going to be harder to spend money. No one's going to go on vacations. And the unemployment rate's going to hit 14%. Like you would have said, okay, the economy and the stock market is going to crash for the next 10 years probably because of this. And it was like a 2 or 3 month thing. And then we just moved on. That's one of the points I always make is that I could give you the economic data and headlines ahead of time. You still might not be able to profit on that information.
No, I think it'd be easy to jump to the like, okay, we're going to have a Great Depression type moment. And even since then, you know, we had AI introduce itself to the world like AI was around before, but not in the form that we know it today. And, you know, how often do these things play out? Again, we run like the same set of facts over 10,000 times. Like how often does it really play out this well? And it does, you know, make you stop and wonder. And for me, at least throw up my hands and say, hey, like, I don't know where the market's going to go. What I do know is what sort of risks get rewarded over time and what sort of risks do not, and what good behavior looks like and good behavior does not. I will tell all those listening and watching, like if you follow Ben's stuff, you do get that nice mix of like acknowledging what's going on in the world, but with a nice long-term tint to it. Ben, I said at the open, but just again for people, like where is it best to find your work?
Yeah, wealthofcommonsense.com is the newsletter. You can sign up there. And yeah, the book's wherever you can find the book. It's going to be out. I'll be talking about it a lot, I'm sure.
Very good. Well, appreciate you being here. Everybody, if you want to find an easy link to the book, you can go to thelongterminvestor.com. I'll have detailed show notes. I'll link to all the different places you can find Ben. But until next time, appreciate seeing you all. Ben, thanks again.